Good morning, everybody. Welcome to today's live event from Interactive Brokers webinar program. My name is Andrew Wilkinson, and I am delighted to have with me on camera here Jose Blasco, who's the trader and founder at Tradictive. Welcome back, Jose. How are you?
Thank you so much, Andrew. I'm very well, thank you. A pleasure to be here. Always lots of fun and great conversations. So thank you for having me.
And your topic today is trading retracements versus trading breakouts. Tell us a little bit about what's on deck here, Jose.
Correct. So, well, it has to do with entries, right? And it's basically very distinct different styles on how to initiate a trade, either when the market is moving in the desired direction already, or when we're expecting a turning point to happen after we enter, which are two very distinct and different philosophies with pros and cons. We're going to discuss that, and actually we'll even talk about how to combine them, because typically they are treated independently, and the fact is that we can combine them.
Brilliant. If you can put up the second slide for ibkr disclosures and disclaimers for the audience, please, Jose. We always put these up at the beginning of every webinar, just to inform the audience about potential risks that are associated with some of the products we may be talking about today. The event is live. It's being recorded. You'll receive a link in a couple of hours after Jose's finished talking this morning. So check your email for that if you're going to watch the replay. But also it will take you to the previously recorded section of the Interactive Brokers campus for webinars, where you'll be able to see other previously aired webinar events from Jose and everybody else that presents with us. Please use the chat panel to communicate, to ask any questions of Jose, and we'll try and do a Q&A towards the end. So with that, I'm going to go on mute and hand over to Jose.
Wonderful. Thank you so much, Andrew, again, and welcome everybody to the session. Again, a pleasure to be conducting today's session about trading retracements versus trading breakouts. My name is Jose Blasco, and well, I'm just a trader, and therefore happy to share my passion, happy to share some knowledge here, hopefully practical application, and ready for your questions towards the end. Start typing any moment. Don't wait until the end to type your questions. You feel free to type any moment so we don't miss any of those questions. So webinar objective, so we need to clarify the difference between retracements and breakouts. We need to explore the trader psychology and market logic behind these two different distinct type of entries. We will learn when to favor each approach depending on market conditions or trader personality, and then we will see how to apply these strategies with TradingView and ibkr. So I'll be using probably a combination of TWS and the trading workstation of Interactive Brokers, as well as TradingView, which I'll bring to the screen right now. So here is TradingView, and TradingView, you probably know that you can click on this bottom part. It says paper trading by default. You can click on that section, go to see the brokers list, and then you can pick your interactive broker and connect to your real-time account with your either paper money or real funds. Okay, so all of those type of possibilities are available, and today, beyond the slide deck I have ready to discuss let's call it the theory behind the ideas of today, I will certainly try to spend time on the charts as well. Let's see how we go. Okay, and again, happy to work with you with those questions as they come. Anyway, so the plan for today, well, I'll spend 2.5 seconds to introduce myself. I kind of did already, and from there we'll move into understanding retracements and breakouts, when to use each approach. Then we'll talk about how to fine-tune even more, because you could argue, I mean, some people may say entries are extremely critical. That's how you really make money in trading. Other people may say, look, wait a moment, it's not the entries, it's the exits. You know, the reality is that both entries and exits play a major role in improving the quality of our trade setups. If you have good entries or good exits or both, you are directly impacting your reward to risk ratios. And if you do that, next thing you know, your trading results at the end of the week, the month, the year looks so much better. So fine-tuning entries, it's going to be key. We'll have other future sessions as well where we'll talk about what about the targets, what about fine-tuning the exits. Okay, but again, today we'll have time for the entries. So again, a little bit of live demonstration as well, and I have some extra resources for you, which are free. So hopefully that will be useful to you. So again, I'm a trader. My name is Jose Blasco, and extremely passionate. I love the markets. I'm a technologist by training, if you wish. So when I got into financial markets, knowing that the markets became electronic in 1995, which is many decades ago. So obviously, to me, it's all technology, and of course, we are in the era of AI and everything else. So my trading style has a lot to do with utilizing tools and using the power of computers, which do, I even said who, given the fact that we are in the AI world, computers do certain things better than humans, and I like to, lean against that opportunity. So I represent Tradictive, which is the company I founded. We provide intelligent tools for traders. Feel free to explore our website. Beyond that, for the ones of you which may be new to trading, which I would assume that we are a mix, some of you may be more experienced, some of you may be more on the beginning part of learning how to trade. So just bringing here a few ideas for you. So we've produced a book. The book obviously is something fairly affordable, and the beauty and the reason why I'm mentioning this is because the book comes with a course, and therefore you have proper tools to get started in a proper way, if you wish, from an educational point of view. And also, if you are more advanced, okay, I'm trying to bring in tools for everybody here. If you're a bit more advanced, maybe a book may be too basic for you, but maybe you would enjoy very much the articles that we publish every week, typically articles related to derivative trading, most of the times futures, also options. And you can follow those articles on our TradingView page, okay, by following this QR code or the link, tradingview.com/u/predictive. You can just follow us and read those articles. Anyway, let's go for it. So we're gonna be utilizing interactive broker technology. Again, TWS, TradingView, those are the tools I'm going to use the most. I will do that later. And we are now beginning the beginning part of this lecture. And the first thing I need to do to understand better retracements and breakouts is to first go over a definition. So we make sure we all speak the same language, because this is sometimes a little bit of a challenge in a field like trading, right? Or I mean, maybe you agree or disagree with what I'm about to say, but to me, trading and fields like, for example, nutrition, for example, are very similar in the sense that many people use the same words and they mean something different. Okay, other fields are more specific, like math, for example. So if someone says, a square root, it's a square root. Everybody knows what it is. But in the case of trading and investing, it's not always the case. So I want to have a little bit of a definition here, so we make sure that we all speak the same language. And this may be a bit basic to some of you, but it's important to be on the same page. So what's a retracement? I said a retracement is a pullback, okay? And a pullback is something typically temporary. So let's say you envision a market which is going to do something like that. Every one of those pullbacks in the context of an overall trend, which in this case is up, every one of those pullbacks could be an opportunity to enter this market by either buying the dip if it's an uptrend, or selling short the rally if it's a downtrend. Okay, so those retracements, those pullbacks, okay, are often very motivational for certain type of traders that love to enter after price pulls back into an area of value. And depending on your trading style, trading tools, trading preferences, and so on, maybe you're a technical type of trader and you use support and resistance. Maybe you are more of a fundamental type of trader and you have modeled the market and you are looking at, a way on how do you value securities, and you have your own way to come up with what's a good price for me to buy or what's a good price for me to sell. And you're just waiting for that pullback, for that market to come back into that support resistance, that, calculated value based on a financial model. If you're into this type of trading, UFO stands for on-field orders. So earlier on my chart, you may have seen some green UFOs and red UFOs. So sell on-field orders, buy on-field orders. So you may be waiting for price to come into these price points, these zones, for price to continue, and you are trying to catch that turning point that hasn't happened yet by waiting for a pullback to happen, for waiting for that retracement. So this is ideal for traders that are seeking better entries with lower initial risk, and it works best in trending markets where the main move is expected to resume. Okay, typically retracements against the trend tend to not to work too well. Okay, and I mean the reason why, first of all, is a trend tends to continue. So if it tends to continue and you're trying to short it, you're trying to fight it, it's often not the best idea, or it's more difficult. And I'm not saying it's wrong, because there are definitely counter trend trading methodologies that may be valid. But it's let's say it's a tougher challenge, if I may say it this way. And also the disadvantage, if you wish, is that if you were to catch this pullback and short, and catch this move to the downside here, typically the problem is that the amount of money to be made with those retracements, it's poor compared to buying the retracement, and now you can profit from the next impulsive move following the trend, which typically brings you to a more juicy target. Okay, so this is normally what's in the mind of a retracement trader, and that's why this may be appealing. Of course, some of you may be thinking, wait a moment, catching a turning point is tricky, it's not that easy. We're going to discuss all of that, because all of those methods have pros and cons, and we need to evaluate all of that. Okay, right now I'm just defining what is a retracement. Now, what is a breakout? A breakout is a strong move beyond a defined level of support or resistance, and traders enter when price breaks past a key zone or range. So, for example, you have a market that has been, doing not much and basically trading in a tight range like that for a while, and a trader may identify this as, look, this is a price range where not much is happening, so I don't know what's going to happen, but if it breaks above, I want to buy and go long, because I would expect a continuation. And if he's not gonna go long, if he's not gonna break up, he's gonna break down. So then I want to go short, because I would expect a continuation to the downside. So that would be a breakout. Okay, you're taking your trade as that pivot low is broken, is violated, or you are going long as that pivot high is violated, right? This trade is breaked out, right? That would be the idea. So this is used to capture momentum as it unfolds. There are many cases where the market rallies or collapses and then breaks for a while and then resumes the move, and maybe the move resumes and then you have those retracements. But if this was the origin of the breakout and you were expecting the next retracement to go as deep for you to buy here and capture the next move, sometimes you will see that full retracement never happened, and this is probably the fear in the mind of those breakout traders that have the fear of missing out, right? They have a bit of FOMO, which could be justified or not, depending on the trade setup. And again, that's why they want to take the trade here right at the breakout point, so they don't miss the move. Okay, because a full retracement may or may not happen depending on how much momentum there is. So if you are really targeting for very strong momentum, which of course you can be right or wrong, like any other trade, but if you are targeting for this very strong momentum, so this particular action of trading the breakout, it's I would say recommended if that's what you're looking for, knowing that a breakout may become a fake out, and the momentum you expected never took place, and then you get stopped out or it moves against you, and you have to do something about it. But again, if your trading methodology suggests and you are convinced that it's going to spike, maybe you are doing this right in front of a news event or something like that, so then that's when you would do the breakout typically, even though there are more cases which I will discuss. So often occurs at consolidation edges, news events, or volatility spikes, and it works better when markets are transitioning or expanding from tight ranges. Okay, so markets that cooled down where volatility has diminished by a lot, and then you have an explosion of volatility, and that's what you're targeting. So a little bit of a summary so far, still so much to discuss, but so far based on what we said. So pros of doing a retracement: you may have better entry prices, Okay, you buy lower, you sell higher, so you have a better entry price, and it favors patience and precision. So you are targeting that beautiful, perfect gold entry point, which means that you have to wait for it. So you have to be patient, okay? And the beauty is that you get that precision. The downside is that you may miss the trade if the retracement never happened, and sometimes a retracement may be mistaken for a trend reversal. So you may feel you're in an uptrend, and then the market is retracing, and you think that you're gonna buy the dip, but next thing you know, what looked like a retracement is actually a trend reversal, and you get stopped out very quickly. So this could obviously also happen. The breakouts, pros, you capture momentum, you have a clear confirmation, you have evidence if you wish. I mean, when a breakout is happening, you have the evidence that you are breaking out. So you are not guessing that after a retracement, a turning point will take place. You are not guessing that. You have the evidence that the breakout has started. Now, of course, you don't have any final guaranteed confirmation that it will continue developing and reach your target. That you will not, and often breakouts become fakeouts, and then it's very disappointing. Okay, but at least you have confirmation that for now the market is indeed moving in the direction you expected. Fast trades, and therefore ideal for news and volatility. So if that's appealing to you, then breakouts may be your style. Okay, for traders that are a bit more conservative, probably not. Okay, probably retracements feel like more peaceful. The downside of trading breakouts is that you get worse entry prices. You may face potential false breakouts, typically known as fakeouts, and it may require wider stops because you are trading volatility conditions which are typically great, which is why breakouts are appealing to you, because you want to catch a very powerful move as momentum is building up. Therefore, placing your stops too close may be the recipe for just a little bit of market noise being stopped out, and then the whole move happens the way you anticipated it, but you're out. So typically, it requires to have stops which go further out. Okay. Anyway, so let's keep going. So now, as you can see, beyond the pros and cons of those actions, probably if I was to run a survey and quiz you all on, what do you like most and why, probably beyond the pros and the cons that I just presented here, you may have undocumented reasons why you prefer retracements or why you prefer breakouts. In other words, there may be a psychological component that has to do with your trading personality and your trader profile from a psychology angle, where you are just from a DNA point of view a retracement trader, or maybe you are a breakout trader. Okay, and that's you. So retracement traders typically prefer to wait for confirmation. They are often more risk averse or strategic, and the fear is, I don't want to chase a move. Whereas the breakout traders, what they fear is, I don't want to miss the move. So they're both right, and sometimes they are both wrong. But the idea or the philosophy is right in both cases, right? It's more about, who are you? Okay, apart from the trading style and other characteristics of your trading methodology, which may be trend trading or counter trend trading, or not even related to a trend, or depending on characteristics of this sort, you may be forced to be a breakout trader, or you may be forced to be a retracement trader. But beyond that, there is the trader in you, right? And if you prefer fast moves, you are a breakout trader. If you prefer to wait for confirmation of value, then your DNA says you are a retracement trader. Okay, so this is something that if you're new to trading, it's a little bit of food for thought for you to think about it and to look at yourself in the mirror and understand who are you, the trader. So when to use retracements, right? So beyond trading psychology and so on, okay, what type of methodologies may benefit from retracements better than breakouts, right? Well, trending markets is probably the best case and the best reason why you would want to wait for a retracement. So you want to make sure you're in a market which is very well defined, where a trending condition is very well established. Okay, I personally use AutoClimate. Later, I'll grant you all access to AutoClimate for free, so you can use tools of that sort if you like it. I mean, there are many millions of other tools, but if you like this one, it's very simple. So blue means you have a statistical advantage for being a buyer. Red means you have a statistical advantage for being a seller. That's it. Okay, and there are more details which I'm happy to discuss later on. But basically, you know, when you have a condition which is defined, and you have statistics in your side, you have odds on your side from a statistical angle, then you know you would say the market has an established market condition. Established or confirmed market condition in this case means a thick, okay, thick dot. Okay, notice here the market condition was blue, but all those dots, they were not thick, they were thin, which means that it is not clear that probabilities are on your side until much later, where the climate or the market condition then got confirmed with a thick dot. Okay, so it could be blue or red, long or short, thick or thin, which is not confirmed or confirmed, right? So when you do retracements, right, you want to make sure your trending condition is confirmed. And again, you may use AutoClimate, you may use any other trading technique. Maybe you do your trend analysis manually, you look at impulse, retracement, you draw trend lines, you name it, million ways on how to do this. But make sure the trending condition is well established. That's the point, okay? Because then that increases the odds that retracements will be retracements. Whereas if your trending condition is not clearly established, then a pullback or retracement may very likely be a change of trend. Okay, or maybe you are in a sideways market and it goes from swing high all the way to swing low. So if you're trying to catch the move in the middle of the price range, you just get stopped out, okay, because there is not a clear directional continuous movement in either direction. So there is no trend, right? So we gotta make sure that is the case. Example. So here we have a trader this trader is not looking at AutoClimate, even though that would be my preference. What this trader is doing is looking at a moving average. Okay, this is the 50 SMA, 50 simple moving average. Okay, so 50 SMA, and you can see that SMA is right there, and then that trader is also looking at Fibonacci retracement lines. Okay, so also looking at fibs, and you can see that the 50 fib going from that swing low to that swing high, assuming the market is going to go back down. So then that fib line is lining up with the blue line average. So in other words, that price point, okay, that price point of 21,503, that price point may give the trader good confidence to buy around this price level, given the fact that you are in a trending condition by having price trade above a moving average, and that price point may be relevant since you have a confluence between a moving average and a Fibonacci line. Okay, so well, this is what happened at the end of the story. So price came into this area, a very strong reaction to the average and the Fibonacci line took place, and then a continuation to the move all the way to the target. So congratulations if you were this trader. Okay, this move to the downside from here to here, that is the retracement. Okay, that's the retracement. Okay, and of course the precision in the entry was critical, and in this case, you know, fibs and moving averages were used. I'll give you more examples in a moment. Okay, now let's talk about when to use breakouts. Okay. Okay, so when to use breakouts? Yes, I was seeing the question there about the sound, but it seems that sound is good. Great. So breakouts are ideal for range-bound markets, nearing compression or key levels. So in other words, you know, as I said before, market is range-bound now, doing nothing, and you may expect that breakout to the upside or breakout to the downside, right? So the market approaches horizontal resistance or support repeatedly, and there is a moment in time where that support or resistance will break, and that's your entry. Okay, you wait for the evidence of the support or resistance to be broken. Issue a little bit with that is that, you know, if you ask two people to draw support and resistance lines, two different people may end up drawing those lines in different places. So I mean, if I turn on off everything I got on my chart here, this is S&P futures. So if I zoom out a little bit, I believe that if I draw a line, for example, here, and let's say you were a technical trader, so some of you may agree with me that this is a relevant price point because you have a recent turning point right there, and therefore this line is representative of a support. Some of you may say, oh, wait a moment, to me the support is here because this is the very important relevant price point. It's a better one. Some of you may say, oh, wait a moment, it's this one here, this long wick right there is the key for me because it coincides with that long wick here and that long wick here, and some of you may say that's better. And again, that's the issue. Okay, that's the issue with that. Okay, even beyond that, if I can do something a little crazy just for fun, so if I was to hide the candles and put a line here, okay, and I'm doing this just for fun, but also because I'm a pragmatic guy, okay, so please do not call me crazy about what I'm about to do. Okay, I'm just gonna move this up and down randomly like this, okay, just randomly, and you know what, look, I'm gonna, just to make sure, I'm gonna turn on the countdown to bar close, okay, so when that number 40 becomes 30, so when we see 30 seconds, I'm gonna stop my line wherever it is randomly. Okay, so I'm just trying to put a random line on the chart. Okay, random line on the chart. Here we go. Oh, sorry. This is the random line on the chart. Okay, I stopped at 30. Okay, so now you go back on the left. Okay, and look at that turning point in the past. Okay, turning point in the past. You know, open of a gap. You know, turning point in the past. And you could argue that some people would call this line very relevant. Okay, and that's the point. Okay, that's that. Sorry, just zoom in by mistake. So that's the point, that, you know, sometimes doing the breakouts, many times those breakouts become fake outs because the lines that we draw, that we believe in because we are the ones who draw them, the reality is that those lines, you know, are or may be subjective. Okay, or maybe you are just coming from 3 losing trades, and then the placement of your lines is different that if you were just coming from 5 winning trades, just because we happen to be human and psychology works at a subconscious level sometimes. Okay, so it's a bit tricky. Okay, so if you were to ask me how to do breakouts, so again, I prefer to use UFO or any automated technology that does the things on the screen for you, so it's not done manually. Okay, again, let's have computers do the things that they do better than humans. So leaving the computer to do the plotting helps me to be more objective instead of subjective. I'm going to be objective all the time. And what I would do is wait for, in this case, 6270.75 to be broken. And if that breakout took place, that's where the trade would be taken. Or if the market goes down and 59.0 was broken, that's where the breakout would take place. Okay, expecting the market to the downside in this case. That would be my approach, okay, to be more mechanical and less subject to some of the potential challenges that come with trading breakouts. Okay, so confirmation, well, you may see a spike in volume as the breakout is taking place. The reality is that often the spike in volume is happening as the move following the breakout takes place. So you kind of, you know, you are kind of late to the party if you look too much at volume. And also breakouts happen fast, so often you have to execute fast. So watching price action is doable. Watching price action and volume and many other things and trying to act quick becomes a little bit challenging unless you use technology. And, you know, with interactive brokers, you can use the ibkr API and you know, algo trade breakouts, you know, so you can certainly do that. But again, if you do it like most people will do, which is look at very relevant price points and execute manually, so, you know, looking at too many things may also become a challenge. This is one of the downsides as well of sorry about that, I just hit the wrong button here. Here we go. Good. Okay, so here's an example. Here we have a technical analyst trading triangles, and we can see the triangle forming here. And the idea is if it breaks above, I'm going to go long. If it breaks below, I'm going to go short. Okay, and in this case, you can see there was a break below, very strong continuation. That's what we're looking for with a breakout. But of course, you cannot wait until price is here before you get in. You have to get right when the triangle is broken, which, by the way, that may mean that this little guy there may have been a fake out. Depending on where your stop was, you may have been stopped out and you are forced to re-enter, and now you may be confident or not to re-enter. Okay, so there are a few challenges, as you can see, with trading breakouts, even though, of course, if you do it right, it's super powerful. Price moves extremely far in your direction, and it's definitely one way on how to trade. Lots of money is made every day doing breakouts in the marketplace, so it's definitely a valid way, which is why we discuss it. Now, refining the entries, as I was saying earlier, is quite critical, and there are a few elements which I, briefly mentioned already, which are to be kept in mind. Okay, to be kept in mind, because the issue when planning our trades, especially if we do many things by hand, is that I mean, of course, if you spend 20 minutes doing chart analysis and plotting lines on your screen and doing writings on your screen and things like that, of course, you're going to believe on your trading plan. And the issue is that maybe you made a mistake somewhere, or maybe you are forcing it. It may have happened, and feel free to comment on the chat box, but it may have happened to you that there was one of those trading days that was a boring day, that nothing was happening, and you could not just sit on your hands and do nothing, and in the end you decided, okay, I'm going to take this trade. It doesn't look exactly like my trading plan, but I'm still going to take it, right? And if you really think about it, if you had done this before, which of course we have all done it at some point, isn't it? Especially in early stages. Well, let's face it. Let's be honest, right? So that's forcing a trade, right? And definitely by doing that, we often put ourselves in trouble. So the idea here is, okay, so you have your trading style. It's either you are a retracement trader or you are a breakout trader, and the idea is fine-tune your entries the most you can. So how can you do this, right? And I'm gonna show you a few examples of that. Okay. So one way is to wait for price to retrace into a UFO zone, or any other way on how to calculate your entry zones for long or short trades. And as I did earlier in a prior example, you look for confluences, even better. So this is the same chart as before that I plotted with a Bollinger Band. But in this case, instead of a Bollinger Band and the moving average and the fibs, we have two UFOs, two on-field order zones. Okay, so these are very strong support zones. And if you look at what happened, so price retraced as we saw earlier, and then it rallied all the way to the target. Okay, so what really happened there is that we actually had three confluences. You had on-field orders and the fibs that we saw before, and the moving average. So again, when looking for retracements, it is very, very advisable, at least in my experience, that you just don't rely on one tool. It's a great idea to rely on multiple tools and be as picky as you like when it comes to accepting an entry. Okay, instead of just like anything that looks like an entry, I'm going to take it. Instead, be very demanding with how you plan your trades. Okay, so this is one thing which is quite important with retracements, because when you buy a retracement or you short a retracement, you are trading in the opposite direction of the price movement, right? So in the prior example, price is coming down, 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 and you buy as price is coming down here. So you better have power wherever you buy on the chart, wherever zone you're utilizing for you to buy, whatever price zone you selected, you better have real power there. So the more the confluences, the more the tools that you have, it should help to add precision to those entries. With breakouts, again, tricky part, as I was saying, is the fact that if the definition of your breakout price point has been done manually, so sometimes it's going to be very subjective. Sometimes it's not. Okay, so let me try to find an example here. So let me turn off auto UFOs, and let's pick Eurostock 50, for example, and let's drop down to, let's say, 1 hour time frame. Okay, so I'm just gonna just to save time. Okay, I'm just gonna rewind the chart a little bit. Okay, so let's say it's here. Okay, and you look at, after severe move, you can see now the market is going sideways, right? So you may say, look, this is the top, and this is, why is it not giving me another line? Okay, interesting. I'm not sure why I'm not getting a second line. Okay, let me do it manually then. So this is the top and this is the bottom, okay? And now you are ready. If it goes above, you do the breakout to the long side. If it goes below, you do the breakout to the bottom side. But again, some of you may say, wait a moment, instead of here, shouldn't it go here? And all of this is the sideward action, okay? And this is, again, this is really the tricky part. This is really the tricky part, okay? Which is why earlier in the screenshot I showed you, instead of doing manual drawing of the lines, I was using an indicator that you can use on TradingView, for example. You can go for technicals. You have patterns indicators, and maybe you like to trade triangles, as I was doing. So you can select your triangle, and if there is a triangle, so here we go. Here's the breakout of the triangle, and maybe you can benefit from that. But the beauty is that I'm not drawing those lines by hand, okay? Let the computers do what they do better than human, okay? That's my philosophy here, which I'm guessing you probably agree with me. And if you don't, I guess it's fine. You know, the market is made of market participants with different styles. But you know, again, the tricky part is this, because look, so what happened there? So now it breaks to the upside, right? So you take the trade long, okay, and now it goes to the bottom part, and maybe now you got stopped out, and now you got short, and now it goes to the other side, and now you got stopped out again. So now you do nothing, and because you got stopped out twice, and now the move happens. Whereas if you had placed the line here, you would have been stopped out once to the upside, but then the trade to the downside would be working in your favor. So again, it's a bit tricky sometimes, okay? And the manual drawing of the lines, apart from being tedious and it takes time, has a lot to do with your psychology. Are you coming from 3 losses? Are you coming from 3 winners? Depending on where you're coming from, you may put the lines in a different place, okay? So my recommendation is just use tools like, for example, triangles, okay? As I showed you a moment ago, that are automatically plotted for you, so there is no human component, okay? Now, beyond that, okay, the biggest issue with breakouts, okay, and feel free to comment on the chat box if some of you have traded breakouts in the past and it didn't work for you, or maybe you trade breakouts in the present and you know you feel that what I'm about to say is true. So comment on the chat box just so you can also give a bit more of feedback to the rest of the group that we are here connected today. So what I'm about to say is that one of the biggest issues with breakouts is that a breakout becomes a fake out, right? So you take the trade, you expect it to go down, and it turns against and it stops you out. Like what we saw a moment ago with the chart of the Euro Stock 50, right? Well, here's what happens. So if that triangle was broken to the upside, this is a high probability fake out because you have a red UFO there. So very likely it would come back down, okay? But if you were to trade the breakout to the downside, that's a high probability trade because there is nothing to stop price from falling all the way to 58. Okay, so this, by the way, is the example that we saw earlier. If I go back, that was the example. Okay, but now the slide I just showed you gets to show you where the UFO support and resistance are, and therefore, you know, it serves very well to fine-tune your entries and get less of those fake outs and potentially more of the full real breakout move that you are expecting to catch. Okay, so breakouts don't always hold. Exit quickly if price returns inside the range. Scale out if the breakout stalls. Sometimes you have a breakout and then it stays there and it does nothing. There is no continuation. So typical action would be to get out. And also consider reversal opportunities. I mean, if you're a technical trader, typically a failed pattern implies that it has to be traded in the opposite direction. Again, that may be a bit aggressive depending on your trading style, but that's, you know, kind of like a classical belief among technical traders, you know, CMTs and you know, the kind of trading style. And breakouts, one of the things about breakouts is that you either got normally, you can have more cases, but typically you have breakouts out of support or resistances. You have breakout out of chart patterns, for example, triangles, like I showed you before, or you have breakouts out of candlestick patterns, such as, you know, dojis, hammers, haramis, etc. Right? In other words, those are typically is almost always technical analysis stuff, right? And again, if you're a technical analyst, typically when a breakout fails, it means that the pattern has proven to be the opposite of what you thought it was. And some people will reverse the trade and trade in the opposite direction, okay? I need to make a point here when it comes to careful with trading psychology, because reversing a trade carries with it very strong emotions in most of the cases. So I'm going to move to live charts and hopefully find a couple of examples that we can discuss. I want to talk about management tips for retracements and breakouts, which I'll discuss in a moment. I want to also mention and showcase that beyond trading retracements in a purist manner or trading breakouts in a purist manner, you could actually combine them and kind of get the benefit of both without really fully suffering the downside of both. Okay, so which may be kind of like the best of both worlds combined. So I'll showcase that with some live opportunity I may find in a moment, and we'll talk about that too, right? And basically, just to wrap up before we get into the chart, so ask yourself, do you prefer waiting patiently or acting on momentum? Are you more risk tolerant or more risk averse? Do you want high frequency trade or precision setups? So your trading style should match your personality, your available screen time, your market conditions, and retracement and breakout strategies are both valid, just not always at the same time, unless you tune them the way I'm about to explain, okay? So typically you are a retracement trader or a breakout, and you just happen to fine tune it. If you are a retracement trader, you fine tune it with breakouts. If you are a breakout trader, you fine tune it with a retracement. Okay, so I'll explain what I mean by that, because it may sound a bit confusing at this stage. So we'll look at the takeaways later as a wrap up for the day, and also I have a few bonus tools, as I said earlier, which I will go back to later as well. Especially, I told you I would grant everybody free access to AutoClimate for life. So here's the QR code, but I'll come back to this. Anyway, so live charts. So let me turn on auto UFOs and let's get into a scanner. And I am going to be scanning for hammers and hanging men and morning stars and shooting stars. Those are candlestick patterns. Okay, those are candlestick patterns. They are normally traded. They are normally traded as a breakout. So if you have a hammer, okay, a hammer, in case anyone is not too much into technical analysis, just so you know, a hammer is kind of like a candlestick that looks like that. Okay, so then when the next candle price goes above the prior high, you take the trade here, right? So it's a breakout of the prior candle. Okay, so that one is easy. It's just, you just need to look one candle away. Okay, so I have hammers, hanging mans, bullish and bearish, morning star, shooting star, bullish and bearish, and then together with the patterns, I am also looking at tech ratings. I'm looking at strong sell and strong buy. A strong sell, because it's very strong, it means it's falling crazy. So two things may happen. It may reverse and come back, or it may keep going. Strong buy means it's rallying like crazy. So two things may happen. It may reverse, or it may keep going because it's going strong, right? So I'm looking for those very extreme conditions, both from the candlestick pattern as well as from the tech ratings. And this gives me those ticker symbols, which now I can go ahead and look manually. And if I see something appealing on the chart, so I'll comment on that. Okay, so let me take a look and see if I see something else, something that is appealing, and I will explain the setup. Okay, so for example, this one, I guess pretty clear. Actually, this is a daily time frame. Let's move to daily charts, okay, because I was doing the filtering on a daily chart. Okay, so this is better. So let me start again. I was looking at the 1 hour chart. Okay, well, here we go. Perfect. So we have a setup here, okay, where you know, you have a very strong move up, you know, getting into a UFO. This is likely going to reverse. So let's say you are a breakout trader. Okay, so what would you do? Well, what you would do here is very simple. You have your hanging man there, so you would just define that. okay, by having two lines, one above, one below. And now you are just waiting for the next candlestick to either break above or below and take the trade. Now, in this case, okay, and I'll ask you to answer on the chat box, and I'll read you later. But you know, the question is, would you go long this breakout, or would you go short only? Okay, based on what we learned. Okay, in order to avoid a fake out, should you go long or should you go short only? Okay, well, not only this candlestick pattern is known as a bearish candlestick pattern, is a hanging man. On top of that, if you think about it, if you had a breakout, it's going to hit sell on field orders, and then from there it's likely going to fail. So the breakout is likely going to become a fake out based on what we learned a moment ago on the slides. So if it was to go down, okay, now I would want to take it, and potentially you can go all the way to 45.88. So that's a great reward to risk ratio if you're risking something like that in order to make something like that. So I'm not sure if it's a 5-to-1 or something like that, but it's probably juicy. Okay, so this could be, again, this is for educational purposes. This is not financial advice or anything like that, of course not. But hopefully the rationale, the risk management components, the trade management discussion I'm putting on the table here is making sense to everybody. Let's keep going to see if I see another type of opportunity. I'm also keeping an eye on the clock. So I'll keep going with live examples for another 4 minutes, Andrew, and I'll break at 10:50 so we have time for questions. So we have a day. Let me see if I can find something else. Okay. Okay, give me a moment. Here we go. So now this one, I'm gonna talk about breakouts, but I'm gonna pretend today is yesterday, because yesterday we had a doji candle, okay, well, it's more like a shooting star, so it's a shooting star candle, okay, the prior day, and if the price was to go down, you would want to take a breakout, and if you did that, that breakout took place today, right? So let me zoom in. Sorry about that, I'm having a little issue here. But you can see here how, here we go. You will see it, if I put it on the white background, you will see here very nicely that the low of the day went below the prior low. So a breakout trade could have been taken right there and you would be short, okay? Not a good trade, to be honest, because, you know, this breakout may become a fake out with a green UFO where it bounces in the opposite direction. So to me, at least based on my trading style, I will not be too excited. But just because we have limited time, let's pretend that green UFO was not there, and you actually, interesting. So real-time market analysis, the buy on field orders are gone. So this opens up real time. It happened as we are discussing it. So that's a fantastic coincidence. And so now we just open up more room for profitability all the way to 17.3. Okay, so that's great. So this breakout to the downside would now make sense to me. But now let's say you want to combine, as I said before, a breakout with a retracement. How can you do that? Well, you would need to use two different types of time frames. So I'm going to drop down to, let's say, 10-minute time frames and see what I see. Okay, and on the 10-minute time frame, okay, on the 10-minute time frame, if let me rewind this to when the breakout took place. Okay, so this is the moment where a breakout will have taken place. Okay, so instead of taking a trade where the breakout is taking place, now that you have the breakout, wait for the retracement into 1889. So you place your entry order at 1889 with a stop above the whole zone, and now you have saved yourself a few cents, which is going to improve your reward to ratio big time. Okay, and now, so of course it requires a little bit of patience, but just a little bit, because I'm using an intraday time frame. Now you wait for price to come here, and now you can see it's beginning to react. And again, I mean, the session is about to be over, but you know, feel free to review this chart, you know, maybe an hour later, and you know, I would think that, you know, odds are it's going to start going down. Okay, because you enter with that red UFO, and now potentially that breakout continues, and then you have a close below the line at the end of the day, and that motivates many more people to short tomorrow. And now a few days later, you reach your target at the price points that we discussed at 17.3. Okay, here we go. So anyway, Time is going so fast, okay? So fast. So I'm just gonna mention, I wanna use this chart to mention the last example I wanted to mention. I have 1 minute left, okay? So, which is, what if you were this trader here? What if you were this trader and you wanted to get short as a retracement? This is happening, this is your retracement. So you wanted to get short and catch the move to the downside, but you wanted to combine retracement and breakout. So you could do the same. Just drop to an intraday time frame, for example, 10 minutes. Okay. Let me go back here. Sorry, I need to draw a line first. So you would draw your line right there. So this is your line. Okay. So that's the retracement is happening, right? And now that the move is happening, you will just pick the candle where the beginning of the move took place. Okay. And inside here, now you will wait for price to begin going down. And the moment that happens, that's where you will take the trade. Okay, so you would be supported by strong resistance above in this case, but you would wait to take the trade after you got the evidence that not only you thought there was resistance, but the resistance is actually pushing prices down, and you would take action right there. And that would be a combination of waiting for a retracement, but taking action as a breakout. Okay. Anyway, Andrew, 1 minute late, but very much ready for those questions.
Okay, thank you very much, Jose. And if you'd like to enter any questions into the chat panel for Jose, now's a good time to do it. It's located in the GoToWebinar tower there. Just enter your questions. There was one question, and I think you covered it. You anticipated it nicely. How do I find the list of stocks that are breaking out?
Oh, here we go. Yes, the screener, both on TradingView or in TWS, you also have watch list and all sorts of tools that are beyond amazing to find opportunities. So yeah, I recommend you very much to explore those.
Can I ask you to, oh, there's a question coming in, but can I ask for a particular symbol that I'm just watching this morning for the first time? It's RKLB, Rocket Lab. And, pardon the pun, but it seems to have lifted off. You're not on the current price there.
Oh, yes, correct. I was still with the market replay function. Here we go. Here we can see the real-time price.
So what's happening here?
Yeah. So if we look at this market, we look at it on a monthly time frame. So this is a chart which is making all-time high. Yeah. And then if we look at it on a daily time frame, so what I see here is that, this move, we are a little bit late to the party if we try to get in now, for sure. I mean, this, we can certainly talk about it as a classical example of a breakout, okay? All-time high breakout. So the breakout took place, then a little bit of a retracement, and then continuation. So this is a classical breakout. That retracement, by the way, could have stopped out many traders, and then you get to see the move. So that's one of the challenges I mentioned earlier in the presentation with the breakouts. Okay, but in any case, if we were to think about right now the present, so again, the breakout already started. We are far higher. 35 from 78 is far much higher compared to 33, 34, and entering now is something I would not welcome very much, because if we look at total climate, while we have a defined market condition, blue and thick, as we said before. So when we look at the stats, we can see that a normal extension level, we call this max distance, which is, what is a healthy push to the upside. So a healthy push to the upside is defined as a maximum 171, where the current push is 2.01. In other words, it's pushing way more than what's healthy. And while it's impressive, it's probably statistically unsustainable. So what I would do, even though, of course, and you could basically guess that my trading style is, I prefer to do retracements instead of breakouts. But what I would do happily is to wait for a retracement into this price zone. Okay, what was resistance may become support, and then catch a new wave, following the breakout. Which, of course, that retracement may or may not happen. But given the fact that the market has stretched in a spectacular manner, like 2 is more than 171, So it's, again, being statistically unsustainable, and the retracement has more odds to happen than not. And I'll be happily waiting for this to happen. And if I miss it, look, I miss it, and I'll find another opportunity later higher up.
Lovely. Thanks, Jose. Please do enter your questions like Kyle has. Are there any asset classes this tool is best for or bad for? And are signals generated by comparing buy versus sell orders?
Yeah, this tool identifies on-field orders, and therefore the requirement is to trade liquid assets. Because if you trade, let's say, a penny stock, then I mean, you could still use it as a guidance, but you have very little amount of on-field orders when you compare a penny stock versus, I'm going to go for an extreme here, the S&P 500 futures contract, right, which is one of the largest, or the 10-year treasury bonds, one of the largest markets in the world. So the larger the market, the more liquid, the more the orders, and the more the orders, the more powerful those, circle zones are going to be. So what I would do is to avoid products that are illiquid, like very tiny stocks with little volume, and putting that on the side. Then you can apply it to anything. It could be stocks, it could be ETFs, it could be futures, it could be commodities, it could be indices, you name it.
Brilliant. Any final thoughts on the overall market, Jose, for us to take away? What's it looking like to you?
That's the question of 2025, isn't it? It's it's a difficult year, let's face it. I mean, it's an exciting year, and definitely plenty of volatility, and also not only volatility from the point of view of speed of price movement, but also for options traders, which I do a lot of options. So, obviously, it's juicy, right? So there are hefty premiums available in the marketplace, and for options sellers, it's been lovely. Having said that, picking direction, it's often difficult, because what we are seeing in 2025 is a lot of speed of movement in both directions. Typically, you see very strong moves to the downside, and if you're wrong, then you get stopped out very quickly, and okay, then you go plan a new trade. And then if you're right, you get to see those trades function at a normal speed in your direction. But this year, we get to see lots of speed to the upside, as well as lots of speed to the downside. So sometimes if you get stopped out a couple of times in a row, it's quite violent in both cases. So that's kind of like the challenge this year, keeping emotions under control. Having said that, look, I would say, I think it's fair to say, and I don't mean to be politically incorrect or anything like that, but I think it's fair to say that the world is probably more complicated than what we have seen for a long, long time this year, with wars and changes of policy, such as the tariffs and things that are difficult to predict and to understand. And while that's happening, the S&P just keeps going higher. So right. the market interest is there. Maybe you could even argue that more than ever. So I would not be surprised to see a new all-time high before the end of the year. And again, one more time, this is not financial advice or anything like that, but that's my reading of when I do my market analysis.
Yeah, I cannot disagree with any of that. And while I would say, yeah, that's likely to happen, I wouldn't be surprised, and you probably wouldn't be surprised if we saw a new low for the year as well,
yeah,
given what's happening.
Correct, yes, because the type of, I mean, is that we have so many conflicts happening in parallel that all have potential to really distort what's happening. I mean, if a war gets complicated, we don't know what can happen. We saw the reaction in early April with the tariffs, which we can see on the chart here in the middle part. So if a new disagreement at a major level happens again, so again, there is more to come during the year when it comes to big surprises, either to the upside or to the downside. So, active trading, risk management, impeccable risk management, discipline. Yeah, that's the way to go, to be able to be safe in 2025, and when a great move happens, to be able to capitalize on it as well.
And I think one of the old adages that's very valid this year is don't fight the tape.
Correct.
Yeah, if it's going, I mean, it's all well and good for any of us to get an individual view on what's happening politically or economically, and trying to kind of get married to that view. And I think you just have to be more accepting of momentum.
Yeah, you're absolutely correct. I mean, the swings that we see in the chart in front of us, which are tremendous, have been recipe for extreme profitability among many professionals. Also, those same professionals that created extreme profitabilities at times during this period, they also had, if I may say like that, a few slaps on the face too. So it's when the market behaves in this manner, really what's key is to manage risk and be very disciplined, and just be proud of managing risk, because even if, let's say, you were to get a loss or two or even 3 losses in a row, and you were to feel like, oh my god, I'm gonna kind of like, I'll stop trading for the year, come back next year. Well, this could be certainly a valid and choice to be respected, but at the same time, this is happening to professionals too in a year that is so volatile, and stop trading. It may be the recipe to not to benefit from the potential moves that then will happen later on. So to me, the key is not to do anything different. The key is really to be just as disciplined with risk management as always, and just treat the market like what it is. It's a machine that is there for us, but we have to respect it with risk management. Never hope and never be biased.
Jose, last question. AC asks, do you have any instructional videos that are part of the program?
Yes. So we have a YouTube channel with like 1,000 over videos. So
okay, there you go, AC. We'll put that on the screen now for you.
And there are playlists. Trade with UFOs. Okay, so that would be the YouTube channel. And there are playlists. So some of the playlists will be futures trading, another playlist stock trading, another playlist options trading, and we're utilizing TWS in many of those videos. So you can kill 2 birds on 1 stone, which is to learn more about trading and also learn more about the use of the platform.
Excellent. Thank you very much, Jose. We are indeed out of time. I always feel like I walk away from these sessions having learned something new with you. So thank you very much for that.
Means a lot, Andrew. Thank you so much to you and to everyone also for joining us.
All right. Thanks to the audience, and don't forget to look out for the replay and the link to the ibkr webinars area on the campus under the education menu at interactivebrokers.com. Thanks, Jose. Bye for now.
Bye, everyone.